Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician. So happy to have you along for this week's edition of the Market Carver. This week, we're going to be talking about the labor market, continuing from last week's Economic Summit. If you joined us, we went into a deep dive in a couple of different categories. So continuing that with a preview of the labor market, then Andrew's going to give us an update on technicals, which we desperately need as we're having some things in the market adjust, we'll say. So let's start right in with the labor market. So the beginning of every month, we get the critical jobs number, the non-farm payrolls that give us an insight into how many jobs are being added in the economy and the unemployment rate. That critical data set is equally important to the Federal Reserve as inflation. Of course, inflation has been a bigger component than the jobs being elevated over the past several years. But the labor market going forward will be drawing some attention, partly because of changes we're seeing on the federal payrolls. If you look at actions so far, there's been 75,000 voluntary resignations. There's been up to potentially 200,000 probationary federal workers, and an additional 200,000 that will be gone through attrition, people who will resign or retire and not be rehired. Add that together, that's about 500,000. Not really enough to change the payroll numbers across the economy. It certainly does. It certainly is in pockets, like in DC and other concentrated areas. By far, the bigger government employer is state and local. And over the past couple of years, that group has been the most important piece to the economy, keeping jobs open. What we're looking at here is a chart that's showing you the percentage of industries that we track across our economy and how many of those industries are adding payrolls. And as you can see, we've been seeing a deterioration in the percentage and the breadth of hiring across the economy. This doesn't mean by any stretch that we are crashing, we are rolling over into a recession. But it is saying as we do see government hiring slow down, potentially even become something of a neutral or a net negative, we need to see the private sector step back in and rejuvenate, particularly in the manufacturing side, which has been contracting now over the better part of a year. So we will see what we have on that jobs report and how it influences Federal Reserve interest rate decisions coming up. As we stood right before we get these numbers, we were looking at maybe 2 cuts this year. As we're seeing some softness in the economic numbers, there's a possibility that we do see those and maybe some more. So jobs and how they develop from here will be a critical input into that factor. So Andrew, I'll pass it over to you to cover the technicals in the market.
Thank you, Adam. So shifting from the economy now back to the market, the chart that I wanted to bring has a lot going on to it. Don't be intimidated. Let me unpack it all. One of the things that we look at every single week when we're evaluating the health of the market is we want to know, are we seeing more stocks rising or more stocks falling? If you've been watching the market cover for really any length of time, you've heard me talk about this quite a bit. This is something I put a lot of time, a lot of focus in, because I really think it's important in understanding, are we seeing a really healthy uptrending market, or are we starting to see a deterioration where more stocks are starting to fall? So when we start looking at the market today, we can see a pretty big separation forming between what large cap indices are doing and the more mid small cap indices are doing. And that's what this chart today looks at. So on the top panel, we have the S&P 500, the large cap index, and then the S&P 6 and S&P 400, the mid and small cap indices. So what we're seeing right now, looking at how many stocks in each of these markets are making new 3-month lows. One of the developments for a bear market or starting to see a protracted downturn is when we start seeing an expansion of new lows, meaning that every time the market starts to tick lower, we start to see more and more stocks breaking down along with it. And so this was one of the early signs we start looking for to think that we might be seeing something worsening. And so right now that's not happening yet for the large cap. Let me come out right out front and say that. For the large caps, we are seeing the market start to move lower. We record this on Tuesday. We're down about 5%. Right now, we're trying to get the market's trying to do a little bit of a bounce this afternoon as we start testing some key support levels. Below the surface, we can see on this chart, you can see in the black that we're seeing actually less 3-month lows so far. That each time the market's gone down, right now, if we kind of get a zoom in on that, see that we're still pretty much in the low double digits for 3-month lows. Compare that to what we're seeing in mid and small caps, where we're actually at 24% of mid caps and 25% of small caps making new 3-month lows and starting to hit those levels we were seeing at the end of December and January. This is what's concerning, that we're starting to see of the small cap markets, which is typically where you start seeing a little bit more risk taking, a little bit more aggressiveness. That's where we're still seeing the bulk of the selling take place right now. So when we look at it as a whole, we're pretty much about even, still below the levels for January when we combine all three of those markets into the S&P 1500, which looks essentially all the stocks in the U.S. Financial system. But right now we're starting to see, again, more weakness in small caps than we are in those larger cap markets. And so that's helping us give a better idea as far as positioning and also evaluating the risk taking or the risk appetite for the broad market right now. So like I said, we're testing some key support levels this week. We're kind of at a really important juncture to kind of really evaluate what's going on in the domestic market. And so we continue to watch the data every day, really trying to parse through to see what's moving things and if we're starting to see things improve or starting to see things begin to deteriorate, and what actions, most importantly, we need to be taking within your portfolios.
Yes, thank you, Andrew. A lot of critical juncture points. But rest assured, we are here battling this every day in monitoring conditions. We send this to you once a week, but we're here throughout the week monitoring these changes and adjusting when necessary. As always, if we can be of help, please don't hesitate to reach out. 800-928-4001. Scan the QR code and do it electronically if that's better for you. And lastly, just a note, be looking out for those thirdly invites. Those have already been sent out. They're right around the corner here as we head into early April. So hope to see many of you there. Again, look for that in your inbox, and please RSVP and let us know. We'll see you. Thanks and have a great week.